Hello, welcome to Learning Lending Live. My name is Harry Dennis. I'm with C2 Financial, a mortgage guru. Welcome to the show. Welcome back. Again, my name is Harry Dennis. So today we are going to be talking about credit in terms of being able to buy a home. Credit is one of the most important factors. Growing up as a child, turning 18 with your social security number and establishing credit. And we're going to talk about do's and don'ts. And we want to educate you out there to prospective buying a home and managing credit. Today I have Mike Officer. He is a credit expert. Welcome to the show, Mike.
Thank you, Harry. Great to be here. You and I have worked together for years, so I appreciate you having me on.
And thank you, Mike. So there's a local article here that was posted probably about 30 days ago that came out through the Wall Street Journal, and it was referring to $1.277 trillion in credit card debt. 55% of the people that have credit cards have a balance and they don't pay it off. Mike, tell me something about this and how high with today's interest rates credit is, and what can this do?
Absolutely. So credit card debt is a significant factor in people's credit profile and their related credit score. The higher debt that people are carrying on their unsecured credit cards, the lower their credit score and the lower their potential of getting approved for financing. It also really hurts their cash flow because a lot of their payments are going towards interest and very slowly paying down the principal on these balances. So unfortunately, many people are drowning in credit card debt. It is also a fact that credit card default is at an all-time high right now. People are defaulting on their credit card payments. They can't afford the payments. And it's a significant financial challenge for a lot of people.
Wow. That's a major issue too, especially I think from qualifying for a home mortgage too, when you see this credit card debt, and which is so important for us, and some of the messages out there is educating, to have a plan, whether just because you want to buy a house now or down the road here, things have to be in line from a credit profile. And then obviously, which is another subject, the inventory here where we are too in Southern California to match up. Mike, I have a typical example. I like to use live, real-time examples is when a client tells me, hey, my credit should be perfect. I make all my credit payments on time. What kind of borrower do you think sometimes that is? And they wonder why their credit is 650 to 660.
I mean, on a positive note, if they have 100% positive payment history, that's great. That's a great foundation to build off of. But I describe your credit profile as a pie chart, and there are numerous slices of that pie. And the amount of debt that you're carrying, the number of accounts that you have, the average account age, the amount of available credit that you have, these are all components that make up a credit score. So just making your payments on time is only one slice of that pie. There's a lot of different areas that need to be focused on and optimized to really align your credit profile with what a lender wants to approve.
Wow, Mike, that is so valuable information because I hear that all the time. My 25 years in this business, even though I'm only 35 years old, of doing this, I hear that, hey, my credit's perfect. I'm making all my payments on time. But as you said, that's one slice of the puzzle. Tell me something about the percentage based on the max that you can charge based on where the balances are in that 30% tier.
If I understand that correctly, the 30% is the kind of the first goal. If people are carrying more than a 30% credit card utilization percentage. So if everybody doesn't quite understand what that means, it means the balance that you are carrying on your card needs to be less than 30% of the limit of that card. And that needs to equalize out as an average across all of your credit cards. You could have 30% on 4 cards, but if you're still maxed out on the other 2, that's going to skew your percentage in the negative direction. So 30% is kind of the go-to threshold for what lenders want to see for approval. What we have found is if you want to optimize how your credit card accounts are supporting your credit profile, you actually want to pay that down to 10% or below. So essentially, you want to carry very small balances on your credit cards so that you're continuing to accrue payment history. But we want those balances to be as little as possible. If you can get it down below 10%, that's where you're going to see your credit score go up, because the amount of available credit that you now have is optimized and supporting your credit profile, and it increases your chances of approval. It also increases your chances of getting approved at lower interest rates.
Wow. Wow. That's valuable to know. So are you telling me it's the utilization of all the credit cards? So it's not just if you have 3 credit cards, I'm like, hey, I have 3 credit cards, but one of them's 0 balance and the other 2 are max. So we're taking it as an aggregate as a whole. Is that correct?
Correct. Needs to be less than 30% across all of your credit card accounts.
Got it. Now, do you think in the process, would it be smart if, let's say, they can't pay it off, to maybe look at getting the lines of credit or the credit card utilization an increase from the lender for them to be able to qualify it? What would be like maybe the pros and cons of doing that?
So there are a couple different strategies for this. That's a great one to start with, is seeing if the credit card company or the bank will increase their limit. So that will automatically lower their utilization percentage, because now their balance is a lesser percentage of the limit. It's probably not going to be a magic bullet if they're carrying high balances, but it will help tremendously. The advantage of doing that is you're not opening a brand new account. When you open a brand new credit card, your credit score is going to take a dip, because that affects your average account age. Your account age average is going to go down every time you open a new account. This is why everybody sees their credit score drop when they open a new loan or they open a new credit card. It's a temporary drop. It will recover in time, but that's why going for a credit limit increase is one of the best go-to strategies to start with.
Wow. So let me get this straight. So if I open up a new credit card and establish more credit, that actually in the short term can hurt me. Is that correct?
That's correct. It will hurt in the short term.
Because of a credit, is it called a credit inquiry and then a new account, right? And it's not an aged account?
For both reasons. You're going to get a hard inquiry on your credit, which drops your score temporarily. And the new account age, the lesser account age, will drop your score temporarily until you establish history with that account.
Can you explain to me and the viewers too as well, what is the difference between a soft hit and a hard inquiry hit?
A soft hit or a soft pull does not show up as an inquiry on your credit, so it will have no impact to your credit score. A hard inquiry is recorded on your credit profile because they're keeping track of how often you apply for credit. If you're applying for credit a lot, you're trying to get a lot of loans or credit cards, they view that as higher risk. So this is why they keep track of hard inquiries, and it will start to drop your credit score as you accumulate hard inquiries.
Wow. No, that's great. That's great information to know. Now, let me ask you a question, because there's different kind of credit pulls, right? How is that different or maybe calculated? Like if I'm shopping for a house versus, let's say I'm shopping for a car or a retail credit card, can you maybe explain those differentials and how that would affect maybe buying a home or the amount of inquiries in that given period of time by the credit pulls?
So generally speaking, we've seen 1 or 2 hard inquiries, maybe 3 within a 6-month period of time is not going to hurt somebody negatively too much. It's when you start to accumulate 4 or more inquiries in a 6-month period. That's where that's going to start showing up as a red flag. Different lenders and different banks are going to have their own internal criteria for risk factoring. But generally speaking, 4 or more inquiries within 6 months is going to start showing up as a red flag and getting you denied for financing.
Yeah. I think too, especially if, let's say, people are getting, maxed on their credit cards, we're seeing that they might apply for 3 different types of credit cards, right? And then that is, I think, could be a really red flag, I think, with the underwriters. Is that correct?
Exactly. Yep.
Yeah. No, that's such good information to know, because from a lending standpoint and a pre-qual, now we have the ability to somebody's worried about when we pull their credit, we can do the same. We can pull a soft pull. And like what Mike just said, and that does not affect or let the public know that we're pulling your credit. So we can do it internally until we're kind of ready to get into underwriting, get loan approval. We can pull the hard credit at the end, so we know where we stand, or to create the plan or baseline too as well. Let me pivot for a second, Mike. What else too is that when we have someone that's maybe maxed out and they can't get more credit, maybe we can establish a plan for them that's maybe over 6 or 12 months to pay down some debt to increase the score. What have you seen of that? And maybe taking good debt and bad debt and how that kind of all, puts together?
Absolutely. I think this conversation starts with developing good financial habits. People need to start with managing their cash flow. They need to start having a plan to pay down their credit card debt faster. There's a number of different debt management strategies. You've probably heard of the snowball method, the avalanche method, but to simplify it, they just need to start putting more money towards their credit card payments and pay down those balances. They need to develop more disciplined spending habits so they're not using their credit cards. And this is really the foundation of a long-term financial plan to be able to enter into the real estate market. People need to get serious about their finances. They need to work for 6 to 12 months and really discipline themselves and focus on the end goal, which is investing into real estate, accomplishing a financial milestone in their life, and being able to get into real estate, be able to get the appreciation on that property. So some very small discipline changes now in their financial habits is going to get them to that point where they're going to get approved.
Yeah. Wow. Again, I think just going into being able to buy, back to being able to buy and qualify for a house is creating that plan. And, whether it be short-term or long-term, on those different techniques of whether it be paying one off to have that momentum or paying it down because that's a higher credit. Because a lot of times, Mike, I hear people, hey, I'm going to transfer my debt to another card because they're going to give me 0% interest for 12 or 24 months or something like that,
Right.
Let's see here. So next point here, we could talk about, Coach Rubin said something about maybe from a qualifying standpoint, there's something newer on the market, is more about this Vantage score. I know one of my lenders have come to fruition about, we could take the best FICO score, or, of the three, because there's 3 bureaus, or using a Vantage score. Maybe kind of just highlight a little bit about the Vantage scores.
Yeah, so this is a new development. Fannie Mae has recently started allowing Vantage scores to be used in approvals. A lot of people don't realize there are 2 different primary scoring models. Vantage is the scoring model that a lot of people are used to with apps like Credit Karma. It's kind of the consumer-friendly scoring model. Usually your scores are a little bit higher. They don't factor in as many things. Credit Karma uses these higher scores to basically upsell their lending partners. And a lot of people don't realize there is a big difference between Vantage scores and FICO scores. FICO scores are more conservative. Your FICO score is what a traditional lender like a mortgage company or a bank for a credit card is going to use to approve you. So the good thing is that by allowing Vantage scores to be used for mortgage approvals, this does open the door to more opportunities for people that are right there on the cusp of their credit score being approved or denied. The thing that is not as obvious, though, is that a lot of your approval is not based on the number of your credit score. It's based on what is in your credit profile. And this is the pie chart I was talking about. This is how many accounts you have, how old they are, how many derogatories you have. So you could have a 690 credit score, but still get denied for a loan because you have charged off credit cards or collections or late payments. So even though the Vantage scoring model is now allowed to be used, it's still very important that we focus on the details of your credit profile and get those cleaned up and optimized so that you can get approval based on that. The credit score number really just determines your interest rate.
Wow. Well, that's, I think too, now with Vantage score, for all the years of me doing it, it's always really been about the FICO score. So it just gives the borrower, the client, the opportunity of another outlet. But I think one of the most important things I heard you say was you still have to look at that credit profile and look at, is it a charge off? How is it? Especially from the mortgage end of things in qualifying, we're really looking at the last 2 years. That's, I'm sure that you could tell me is the percentage of weight given on some of probably those algorithms or scores, especially in the last 2 years, because we look at lates of whether it be a mortgage or a credit card or an installment loan, the three types of lines that we look at in the last 2 years. You want to comment on that at all, Mike, too?
Yeah. And I think that really comes down to the different types of loans that people are applying for.
Yeah.
Different lenders, different criteria, and different types of loans. I think a great example is a VA loan. VA loans technically don't have any credit score requirement, right? But people that have derogatories, they have defaulted accounts, collections accounts, are still getting denied for their VA loan because of the derogatories that exist within their credit profile. So depending on the type of loan you're going after, there are going to be different requirements, and you're going to want to clean up your credit and optimize your credit based on the type of loan you're going for.
Yeah, and no, that's a good point. And we could talk about that later in the future of the different types of loans. Basically, you have a conventional, that's a Fannie Freddie, and then you have an FHA that's more of a first-time home buyer. That's a little more lenient. And then you have the VA, which I think is, if you're a veteran and being able to qualify, is one of the best loans, if not out there for the veteran. The government obviously really takes care of our veterans. I mean, they literally can buy a home with 0% down with an amazing interest rate and no mortgage insurance on a monthly basis. So the veteran loans is and they deserve it. It's a real gift to be able to get in home ownership. As we know, home ownership is really, really tough here in where we live too as well. So let's get back more to credit and the good debt and the bad debt. Really, if I was, getting ready to buy a home, what's the, maybe some do's and don'ts and some things with credit to be able to position myself to be able to maximize, I can buy something. And like you said, at the best optimal rate, because we know things are just so expensive, here where we live,
So I think it's always good to be focused on at least a 12-month plan. If you're have issues with your credit, if things aren't aligned properly, I would say 6 to 12 months in the very least, because you want to focus on every piece of it. You want to pay down your credit card debt. If you're looking at buying a home a year from now would be a great time to get a personal loan to consolidate your high interest credit card debt, because it allows time for that new account to age. That all the credit score drop from opening a new account is going to fade with time. You're going to establish payment history with that new loan. And most importantly, you're going to transfer your high interest debt to a lower interest vehicle. This is going to save you money on interest. It's going to free up your available credit on your credit cards, which is going to help your credit score. So that's one really good move people can do that are carrying a lot of credit card debt, is to see if they can refinance that credit card debt into a personal loan, or maybe a 0% APR credit card, just some way to free up cash flow so they can pay down their debt faster. When you're working with a year before your purchase, you have the time to make those moves, and your credit score will rebound from any new account that opens. The other big factor here is credit repair. A lot of people have derogatories from the past. This could be anything from a charged off account. This could be a collection account. It could be late payments. I've seen people with backdated child support. There's lots of different things that can affect your credit score. And there are effective ways that we offer to clean that up and get those removed from your credit report. All of this plays into a long-term plan, because credit repair is not a overnight process. It's a process that takes months to do it right. And you want to have that time to go through that process, remove the negatives, improve the positives, build your credit profile, and again, align it with what your lender wants to approve for your mortgage.
Wow. No, that's awesome fact. So you're telling me, in an ideal perfect world, if I'm thinking about buying a house or even thinking about it and I'm a year out, it's to get with you, Mike, as a credit expert, to come up with a plan, talking to me, talking to you, to be able to optimize, my plan to get the best rate, because I want the best rates possible with how high these payments and mortgage and tax and HOA and all that kind of stuff, right?
Absolutely. I think first most important call is with you. Form a plan about where do we need to get to be approved, and then second call is to me. How are we going to make those happen?
Yeah, yeah. I think too, if we go back to the home ownership side, if you're a first time home buyer, definitely getting a plan and understanding, sitting down with myself or Mike. I always tell my clients I will go as slow or as fast as you want during this process, because it's a long term process. We know that. And this is a lot of times the biggest asset someone is going to buy is their home. So we want to put them in a good position. I qualify for a lot of people that can buy a lot more, but I don't want to put someone that's, it's 50% of their payment is going to the house and all that. We don't want them to be house poor or cash flow poor as well, because as we know, when you buy a house, you want to furnish it, and then you want to do the landscaping. And where we live, that stuff adds up. And that's when you see, Mike, how many times do you hear people, oh, I'm going to buy a TV and a washer and dryer, and they're giving me a 0% credit card? What do you think about those?
I mean, hey, if you have the cash flow to pay it off before that offer expires, great. But it's a trap. And they do it on purpose because they know a lot of people are going to forget about it. They're going to let it ride. And once that 0% offer expires, a lot of times with a lot of those plans, they backdate that 29% interest for the entire period. So all of a sudden you're going to get slapped with a really big payment, and immediately it's going to be very difficult to pay down that principal. So again, if you do it intelligently and you can make sure that you're paying off that balance before the intro period expires, more power to you. But don't forget about it. Don't fall into the trap.
Oh, we see that quite a bit too, because somebody, you don't have payments for 12 months and it comes up and they forget about it.
Exactly.
It's a $2,000 payment added or whatever it is because of that 12-month interest, which is great. But I do want to make a point though, and I tell clients is when you're in the home buying process, do not buy anything, a new car, trade in a lease, furniture, TVs, washer, dryer. Wait till you're after we close, because that really could affect. And I've seen people not qualify because they've taken on new debt. And I blame it just as much on me of not advising them or communicating with them and letting them know, do not run credit, do not inquire new debt during the process itself. Obviously, if we're a year out, let's sit down and figure that plan out. But if you're in escrow with a new property, definitely don't want to take on new credit, because that, as Mike said earlier, right, Mike, that those things can affect new account credit inquiry. Those things can affect credit score, because they will check things at the end before that wire is released too as well. They will double check all that stuff and they will find out.
Yep. And if I may add an important note, if you are looking at doing credit repair and removing negative accounts, this is super important that you do credit repair the right way. Credit repair needs to be done 100% legally so that those accounts are removed permanently. Credit repair not done correctly can result in the accounts coming off temporarily and then coming back on. And this would be disastrous to happen in escrow on a property. So you have to make sure that you vet a credit repair company and that they are doing their disputing the correct way and legally under federal law.
Wow. So kind of, Mike, how do you think you separate some of yourself versus, I get all these, especially now with AI, right? Like if I'm looking for credit or credit repair or something, I'm probably getting hit up so many different times. Like what would you recommend that, those things that's important where it's not a scam or they're taking whatever that may be?
That's a really good point. I'm actually doing a series on social media right now on how to spot credit repair scams. So really, the most important part is educating yourself on what you're going to see and how to tell what the red flags are. And I think the easiest way to spot it are the companies offering things that sound too good to be true. They'll offer complete credit sweeps in 30 days. The other word to look out for is guaranteed. By law, a credit repair company is not allowed to guarantee the removal of any item. So anybody who's guaranteeing that they can increase your score a certain amount, guaranteeing they can remove accounts in 30 days, This is all too good to be true, deceptive tactics.
Mhm.
And while, yes, they actually might remove the accounts in 30 days, they're using illegal tactics to do it. And those accounts will come back on. They will come back on in the next 60 days. So essentially, it's a scam. They're taking your money for a temporary removal. Those accounts will come back on. And the tough part for consumers is that these companies are not telling them how they're getting these results. They're just claiming that they can get these amazing results in short periods of time. So if you run into any of that, a legit credit repair company is going to set proper expectations that this is going to take months. This is going to take at least 4 to 6 months for most people to do credit repair the right way. They're going to be in consistent communication with you. They're going to describe their dispute process in detail and set proper expectations. So that's a good way when you dive into the social media rabbit hole of credit repair. You're going to start to see all the companies out there offering these quick fixes, and you'll know immediately it's a scam. It's not.
Yeah, good point, Mike, too. My dad always said growing up, if it's too good to be true, we know it's too good to be true, obviously.
That's exactly right.
I think let's do some maybe the takeaways, I think, of the last 30 minutes to wrap this kind of up. What's a good, let's say, I'm not sure, I'm all over the place. What's a good game plan? Again, maybe reiterating, like, I'm so confused. How do I get started, in this process, if that's what my goal, whether to be to buy a house or just to improve my credit? What's some good takeaways, Mike, from that?
That's a great question. I think it starts with stop being embarrassed about your credit. Don't be fearful of it, and realize that there are actually legitimate and effective ways for you to overcome credit challenges in a relatively short period of time. In the next 6 to 12 months, you could be out house shopping. You just have to start, number one, by committing to better financial habits. And number two, starting a conversation with Harry about what do we need to do? What boxes do we need to check so that we can be approved for our house? And number three, get in touch with me and we will start to form a plan on taking care of those items. But it starts with financial habits. It starts with realizing that bad things happen to good people. There are millions and millions of Americans that have issues with their credit. And a lot of times it's not their fault. They fell on hard times. They lost their job. They had medical problems. Mm-hmm. These are all legitimate challenges that happen to good people in their life. So make the decision to have the mindset to start investing into yourself, form a plan, have a long-term plan, and consult with professionals that you can trust who are going to guide you in the process.
Yeah, Mike, I like that too. And, if you're looking for a home, you're looking, start with me. Let's go through things. And then obviously he's getting you over to Mike. The one thing, Mike, I do like about you is he's the principal. He knows it. He's seen so many different scenarios as I have in the loan things. And it's not some corporate company, right, where they're just firing letters. It's $99 a month. You hear this, but they're firing letters hoping they'll get removed. And then if it is a legal tactic, that is going to come back on before we even get into escrow too. So I think those are just really important components. And I think our goal is really to educate so you can make some prudent decisions based on our past experiences and just laying out the facts to create the game plan. I mean, as we know, they start out credit when you're in college, giving you a free t-shirt or a free ticket to a game, so let's not, it's, nothing's for free. There's always something behind it, but just understanding and educating. And we're glad to reach out to Mike, to myself, and we can get a deeper dive, with any of these concerns, particularly to your own matter, that we can help you with too as well. So I'll kind of leave it at that. Mike, anything lastly to wrap it up?
Nope. Harry, you covered it well. Thank you so much for having me on. I really appreciate it.
Okay. Thank you so much for your time. Thank you, guys.